Welcome. My name is Van Richards. I'm a chartered financial consultant, and I'm here to talk to you today about one of my favorite companies, Disney. I hope it's a favorite company of yours too. What we do when we get together on a daily basis is we take a look at the different companies and we look at the stability, the earnings, and the competitiveness of these companies. And I try to help you to make good decisions on whether these stocks that we're talking about are good values or bad values or something in between. So let's go ahead and get into today's daily stock analysis of Disney. I think you're going to enjoy a lot learning about Disney today, because even though that they've been hurt by the pandemic, as a lot of you have too, I think that there's a lot of promise that's out there, because as the vaccine and the virus starts to wane in the future, we hope that it does, we pray that it does, Disney is one of those companies that I believe is going to be prepared to take off. And that's what I want to talk about today. I want to talk about what they disclosed in their earnings call on the 12th, and then we can talk a little bit more about what's to come from that standpoint. Now, just as I do every day, I remind you that I'm a financial planner. I help people and I advise them on their different investments. I help them with their retirement planning, with their financial planning. And if that's something that's interesting to you, go over to richardsfinancialplanning.com and you can learn a lot more about it. So let's begin though after this and get right into learning a little bit more about Disney. You know, what I'd like you to do is, through this short video, it's only about 20 seconds long, is pay particular attention to the different segments of the business that Disney has and look at the increases or the decreases in the revenue. Now, the revenue reports that you're going to see in this short clip that I've prepared for you is based on the 2020 year over year numbers. So let's take a look at this together and see how things are functioning and how things are working over at Disney. Hope you enjoy it. The Walt Disney Company, $261 billion in market capitalization. This is an awesome company. There is not another company that's going to be like it. And that's one of the things that I want to talk to you about today, because I talk to you about this every day when I talk about stocks. But if you're new, hit the subscribe button, because you'll learn stuff every day. We talk about the stability, the earnings, and the competitiveness of all of these companies. And we also talk about the moat. Really, the moat for Disney is incredibly wide. It's what this does. Remember, that moat is that invisible barrier that's in between the company and their competition. And when we look at Disney, Disney has a wide moat because there's a lot of competitors with Disney, but there is no other Disney. They have a brand that is just identifiable anywhere. Everybody knows Mickey Mouse, but Mickey Mouse is not really even the face of Disney nowadays. What's the face of Disney? The Mandalorian. It has unique content also. They have Marvel, Pixar, Lucasfilms, Disney Animation, Disney Live Action, and 20th Century Fox. Plus, they have ABC and they have Hulu for pay-per-view, and also the Disney Plus. I've not really understood why they have Hulu and Disney Plus separated, but that's above my pay grade. But as we look at this company, we also want to look a little bit more at the actual finances of it. Now, I don't want to get too geeky on you, but I do want to recognize that there are some different aspects of this company that you can use with any company that you're trying to determine whether they're a good investment or not. And the biggest thing that most people look at is called the current ratio. What I did is I went to Disney's report that came out on the 12th, and I took the current assets divided by the current liabilities, and what it gave me was a current ratio of 1.33. Anything in between 2 and 1 is considered good. Now, here's another statistic that I went back to 2019 because you might be going, boo-hoo, Disney's doing bad because their parks are closed. They're not doing as bad as you might think that they are. And if you look at the cash flow, you're really going to see what's going on there. The cash flow ratio is 0.19. Now, most of the time with a lot of companies, if you were looking at a small company, you would probably want that number to be above 1. But the way that we identify it with companies, publicly traded companies like Disney, is we look at it year over year. Now, this was 2019. Let's look at what happened in 2020. If we look at it over cash flow, they actually had an increase in cash flow of $163.2 million in the midst of a pandemic. Now let's look at the information that came off of the different segments. This was highlighted in the video that I just showed you a few moments ago. But what I want to do is go over the bad news and then get in the good news as we're going forward. We all know that the parks revenue is down. It dropped about 37% year over year from 26.225 billion, that should be a billion there, to 16.5 billion. The other area of their business that didn't do that great was the studio entertainment. It dropped by about 13% year over year. But here comes some of the good news that's keeping Disney moving forward. Their media earnings increased by 14% year over year. And here is the big number. Here's the big number. The direct-to-consumer increase, that's Disney Plus, increased year over year by 81%. I think that this company is poised to go higher. If we look at the earnings graph, remember the dark line is going to be the actual earnings per share, and then the dotted line is going to be the estimated earnings per share. And they've really hit the mark almost every year, except in the past year. Of course, we had this thing called a pandemic that really interrupted with things. But if you look at the very end where my cursor is here, you can see that they are projected to turn into go from the red into the black. Now let's look and see what some of the different market analysts are saying about Disney. Those that are bullish on Disney, the biggest thing is that the parks that are open, now I know there are some that are closed and some that are closing, but the parks that are opening are rebounding significantly. A big thing that is an advantage for Disney is Star Wars. If you haven't watched The Mandalorian, you are missing something. That's a reason, if anything, to subscribe to Disney Plus. It makes the force strong with Disney, as the saying may go. Disney's library content is huge. Think of all the old Disney cartoons and the old Disney movies. They have all that content. Not just that, but they have the new stuff from Marvel. And I'm still wondering if Iron Man is going to go through a time vortex with Doctor Strange and come back and make another movie. Robert Downey Jr., we need you in 2020. Here's what the Bears are saying about Disney. The pay television could actually slow the network's growth. And really that has to do with negotiations with local television companies. You have to remember that ABC is a property of Disney. So when you watch a major network, you're watching Disney, and they have to they have to do negotiations with network providers to be able to bring that to you, not just in pay-per-view. The other thing is increased sporting fees. We actually saw, if you were to look at ESPN, you wouldn't think that there was much on ESPN, but ESPN actually had an increase in revenues of about 26% this year, even though that there was the pandemic, because people were tuning in to watch what little sports there was. TV was really all that there was that was available, unless you're watching David Portnoy over on the day traders. The other thing is that mass markets are unpredictable. They've had some Star Wars movies, which some of the people who really follow Star Wars don't like. So they've come out and they've changed different producers and gone forward from that standpoint. Now, this is what Morningstar is saying about Disney. With the current value at $144.50, what Morningstar is pegging the fair value is at $127. So that means that it's a little bit overpriced, about 13 to 14%, not terribly much. But Let's take a look and see what the other analysts are saying. And this is a closely followed company. Disney has a lot of analysts that are following it. And really, just to kind of let you know how this works, an analyst generally will write a report or a review of a company in depth about every 90 days. It may be sooner if something's happening. But generally speaking, there's about 17 analysts that are following Disney very closely. And the majority of them, 10 out of 17, are saying that it's a strong buy. 4 of them are saying that it's a hold. And only one is actually saying that it's going to be not a buy, or it's going to be a sell. Okay, let's take a look at the other companies out there that compete with Disney. Now, pay very close attention to this, because we're going to start to talk about the type of company that Disney is. And when I say the type of company, what I'm referring to is value versus growth. Now, when you looked at the valuation of Disney, as you saw a moment ago, Morningstar rated it as a 3-star company, and most 3-star companies are rated as value. But really, when you look a little bit closer, they're coming closer maybe to a 2-star as they increase in value. So we're going to say this is a blend between value and growth. When we compare it to a company that is in really direct competition, it would be Comcast. Comcast is going to be the closest because they have NBC Universal, they have theme parks, they have networks, they have movies, they have a online cable. So that's the closest competitor. And when we look at the lines, look at the spaghetti graph. Disney is underneath everybody else, and then you'll see Comcast right above it. Well, what do you think these lines are here, the green and the gold? I'll give you 2 guesses. One of them is Amazon, and the other is Netflix. Now, a moment ago when I talked to you about value and growth, we see that Disney is a blend. Comcast is actually going to be undervalued to the point that it's considered a value stock. And then Amazon and Netflix are considered growth. Now, why is this important? The reason that it's important is if you listen to any of the prognosticators about value and growth, you hear a lot of news about the way that the economy is shifting, that things are shifting more to favoring value companies as opposed to growth. Although, you still need, I think you need to keep growth. Now, this is the way that I do it for clients. I have a blend, and I didn't come up with this idea. This is an idea called the modern portfolio theory. And what it does is it blends growth and value and international and domestic stocks together. Now, there's a wide variety of different blends that you can get, but I'm kind of like coffee, I guess. But we're going to use one, and it's going to be the aggressive portfolio. This is the one I showed you yesterday. Now, if you're looking to diversify, that doesn't mean that you just have to go out there and buy a whole bunch of different stocks. You have to have some theory about this. Now, the idea is that if you use the modern portfolio theory, yes, it can decrease your overall return because you might be missing that Palantir that's out there if you're investing 100%. But if you had invested in Wirecard and you saw your money go to Hades in a handbasket, then you would have been glad to be diversified. So this is the way that I do it for clients that are aggressive investors. I'll take 36% of it and I'll put it into a large cap value. Now that's changed. You'll see I slashed out GARP. GARP stands for growth at a reasonable price. And I am shifting more towards value stocks, which are going to be companies like Disney that are a little bit more value oriented. Now, also, I'll put large cap growth stocks, and it may be companies like Netflix or like Amazon or Apple, or those are all growth companies. Also, I'll include in there some small cap stocks. They're going to be smaller companies that have greater potential. Generally, they're going to be companies that are a billion and less. There are some companies which are around the 5 to 7 billion that could be considered small companies, but most of the time when they get over 7 or 8, they're going to be considered mid caps. International developed is going to be large companies outside of the United States, and then emerging growth is going to be stocks that could be from countries that are still growing and developing. Now, I personally would put a company like Mercado Libre in the international emerging stocks, even though they do business all over South America. I would probably put them as a cross between the international developed stocks and the international stocks. We'll talk about that another day sometime. Let's look closely at what's happened and why I think that Disney's a value. A year ago, they were 146.77. And of course, today they closed at 144.50. That's a negative return, folks, of a year. We hope that the past performance is not a guarantee of the future results, but I always have to say that because that's what my business requires. But let's take a look at the 3-year history. If we look at the spaghetti graph, this was the pandemic that hit. 3 years ago, Disney was trading at 99.79 and a little bit. And then today, of course, closing at 144.5. Despite the fact that there was a pandemic that occurred over the past 3 years, it's averaged a total of 44.83%. The APR, the annual percentage rate, despite the fact that we saw a negative return in the past year, is 13.13%. That's really not too bad. Now, I have to tell you, obviously the past performance is not a guarantee of the future results, but you have to be the judge in there. Let's take a look at what some of the analysts are saying right now about Disney. The most, I'd say, conservative or speculative, however you want to say it, is Royal Bank of Canada. They're putting a range in here of 124 to 170. And when we look at JP Morgan is putting a price between 155 and 160. And if you look at the price of it today, you can see that there is some room to grow on this stock. It's all opinions, folks. It's not a guarantee. In the opinion of me and a lot of these analysts that are out there too. So we've gone through everything today. We've looked at it and we have compared the stability, the earnings, and the competitiveness. And I really think that when we look at everything together, that this company is this. All right, friends. I hope you enjoyed today's review. Remember that if you've got a stock that you would like me to review, put it into the comments. I love to read your comments from all over the world. It's exciting to read about what your opinion is, good or bad, whether you agree with me or disagree with me. Now, if I don't review a stock that you've put in, please don't be disappointed. Put another one in, because today wasn't something that someone had requested, but it's something that I saw that was important to cover because I think that it's a good valued stock. Now, there are other companies like Palantir and some of those other companies that I've covered that are requested by you, and I will continue to do that. But remember that, or I want to tell you the way that I do this, I can't review all the stocks because I can't do the independent research. I don't have the research analyst that Warren Buffett does. I do this all myself. And what I do is I go to companies like Zacks and Dow Jones and to Morningstar, and I call through their information. In the mornings, I work with clients. In the afternoons, I work for you. And I help you to understand a little bit more about the stocks that are out there. Okay, so that's all I'm going to go through today, friends. I hope to hear from you, and I hope you come back tomorrow when we review another stock. Stay tuned for the disclosure, and have a good evening.